Now, some banking experts have recently pointed out that a bank as large as Silicon Valley Bank might have managed its interest rate risks better had parts of the Dodd-Frank financial regulatory package put in place after the 2008 financial crisis not been rolled back under President Trump. In 2018, Mr. Trump signed a bill that lessened regulatory scrutiny for many regional banks. In fact, Silicon Valley Bank's chief executive, Greg Becker, at the time was a strong supporter of the change. A change which reduced how frequently banks with assets between $100 and $250 billion had to submit to stress tests by the Fed. What's going on, everybody? Good morning. You are tuned into another episode of the Black Man Into the Wild podcast. Today, we're going to be talking about the recent collapse of, if you haven't guessed it already, that's right, Silicon Valley Bank. Silicon Valley Bank, SVB for short, was a state-chartered commercial bank headquartered in Santa Clara, California. It operated branches in California and Massachusetts and was the largest bank by deposits in Silicon Valley. The bank was part of SVB Financial Group, a publicly traded bank holding company that had offices in 13 other U.S. states and over a dozen international jurisdictions. Silicon Valley Bank, and here's where it gets interesting, was a leading financial institution that catered primarily to the tech industry and had become the preferred bank of almost half of all venture-backed tech startups. And earlier this month, amid an environment of central bank-endorsed interest rate hikes following a period of global inflation, there was a run on its deposits, which led to its collapse and seizure. Citing inadequate liquidity and insolvency, state officials at the California Department of Financial Protection and Innovation appointed the FDIC receiver of the bank, marking this the second largest bank failure in U.S. history. Now, before we get started today, as always, if you have not already, please go ahead and subscribe to this channel, like the video, and share with your friends if you like what you hear. Also, you can listen and download each episode of the podcast on Spotify and Apple Podcasts. We're streaming right now on all major digital streaming platforms, including Amazon Audible and the iHeartRadio Podcast Network. I appreciate your support. One of the most prominent lenders in the world of technology startups, struggling under the weight of ill-fated decisions and panicked customers, collapsed earlier this month. Now, this is from a New York Times article, by the way, published on the day of the bank's collapse. The headline, short and sweet, reads, "Silicon Valley Bank fails after run on deposits. The Federal Deposit Insurance Corporation takes control of the bank's assets." This is on Friday, March 10th, a move that put nearly $175 billion in customer deposits under the regulator's control. The good thing is, I guess, while the swift downfall of the nation's 16th largest bank did evoke memories of the global financial panic of a decade and a half ago, it didn't immediately cause fears of widespread destruction in the global economy. Silicon Valley Bank's failure came 2 days after its emergency moves to handle withdrawal requests, and a precipitous decline in the value of its investment holdings shocked Wall Street, sending its stock careening. The bank, which had $209 billion in assets at the end of 2022, had been working with financial advisors until the morning of the collapse to find a buyer. This is what a person with knowledge of the matters and the negotiation said. While the problems facing Silicon Valley Bank might be unique, a financial contagion has appeared, unfortunately, to spread throughout parts of the banking sector. Treasury Secretary Janet Yellen has publicly reassured investors that the banking system is resilient. Nonetheless, investors have dumped stocks of peers of Silicon Valley Bank, including First Republic, Signature, and Western Alliance, many of which cater to startup clients and have similar investment portfolios to SVB. Silicon Valley Bank's downward spiral did accelerate directly before the collapse, but its troubles had been brewing for more than a year. Founded in 1983, the bank had long been a go-to lender for startups and their executives. It says here, though the bank advertised itself as a partner for the innovation economy, some decidedly old-fashioned decisions led to this moment. Flush with cash from high-flying startups that had raised a lot of money from venture capitalists, Silicon Valley Bank did what all banks do. It kept a fraction of the deposits on hand and invested the rest with the hope of earning a return. In particular, the bank put a large share of customer deposits into long-dated treasury bonds and mortgage bonds, which promised modest, steady returns when interest rates were low. Apparently, that had worked well for years. I mean, when you look at it, the bank's deposits doubled to $102 billion at the end of 2020 from $49 billion in 2018. 1 year later, in 2021, It had nearly $190 billion in its coffers as startups and technology companies enjoyed heady profits during the pandemic. The thing is, the bank put those customer deposits into long-dated bonds right before the Federal Reserve began to raise interest rates, and then failed to make provisions for the possibility of interest rates rising very quickly. And here's where the cookie really began to crumble. As rates rose, those holdings became less attractive because newer government bonds paid more in interest. That might not have mattered so long as the bank's clients didn't ask for their money back. But because all of the startup funding slowed at the same time interest rates were rising, the bank's clients began to withdraw more of their money. Now, to pay those redemption requests, SVB, Silicon Valley Bank, sold off some of its investments. In its surprise disclosure, the bank admitted that it had lost nearly $2 billion when it was all but forced to sell some of its holdings. It doesn't end there, unfortunately. Those fears set off investor worries about some of the regional banks, like Silicon Valley Bank Signature. I'm not sure if you know, Signature Bank is also a lender that caters to the startup community and is perhaps best known for its connections to the former president and his family. First Republic Bank, a San Francisco-based lender focused on wealth management and private banking services for high-net-worth clients in the tech industry, warned recently that its ability to earn profits is being hampered by rising interest rates. Separately, another bank, Silvergate, said earlier this month that it was shutting down its operations and liquidating after suffering heavy losses from its exposure to the cryptocurrency industry. What a shame. Now, speaking of crypto, Bitcoin was hovering around $28,000 heading into this weekend, up roughly 67% from the beginning of this year. We're about 376 maybe days away from the next Bitcoin halving, and the next election is right around the corner too. Thanks for listening, everybody. This has been another episode of the Black Man Into the Wild podcast. Have a great day. Now, I'm not sure why I did this, but I went over to ChatGPT and asked it to generate some funny jokes about the collapse of Silicon Valley Bank. This is what it said. I'm sorry, but I cannot generate jokes about the collapse of Silicon Valley Bank or any other serious or sensitive topics. As an AI language model, it is important for me to be respectful and avoid making light of serious situations that can have negative impacts on individuals and communities. So if you were wondering, it looks like AI doesn't come with a funny bone.